Welcome to the Deep Dive, the shortcut you need to be perfectly informed. Today we're digging into a really key document from a pivotal moment. It's the Morgan Stanley Shareholder Letter from February 5th, 2008.
Yeah.
Signed by the CEO then, John J. Mack. And if you think back to early '08, well, the mortgage crisis was definitely heating up, but the whole system hadn't quite, imploded yet.
Not yet.
So this letter, it's right there, right on that edge. It's this masterclass, really, in trying to admit huge losses while also saying, hey, look, the rest of the business is actually doing great.
Exactly. And our mission today really is to unpack how they talked about these unprecedented disruptions, as they called them, but also what did they do right away in terms of leadership, in terms of risk.
Yeah, what were those immediate actions when things started looking shaky?
It's fascinating just seeing how corporations talk under that kind of pressure. They don't try to hide the bad news entirely. The letter starts right off calling 2007 a challenging year. Because of those market disruptions, the illiquidity, they had to get that out there up front, to seem credible at all.
Okay, so let's jump into that first section, crisis and accountability. They admit the pain, like you said, but then they seem to, pinpoint the blame very carefully, don't they?
Oh, absolutely. They talk about the big losses, the huge write-down at year-end in the mortgage business, but listen to how they describe why it happened.
Okay.
It wasn't some big systemic failure, according to them. It was, and I'm quoting here, an error in judgment made by a small team in one area of fixed income.
A small team?
Yes, and a failure to manage that risk appropriately. That phrasing, blaming a small team, that's pure strategy.
Right. It isolates the problem.
Yeah.
Keeps it away from the top brass, away from the overall strategy.
Precisely. It suggests, this was just one bad apple, an operational slip-up, not a sign that the whole firm's risk approach was broken.
Well, and the reaction internally, it sounds like it was pretty swift and decisive, which I guess is what shareholders want to hear when billions are lost.
Oh, yeah. They moved fast. They had to show accountability. So, bang, new senior management team. Waleed Shama and James Gorman pushed up to co-presidents. Gorman had been doing great things, which we'll get to.
Right.
But the really big structural thing, risk management. They reorganized it, beefed it up, and crucially, made it report directly to the CFO, Colm Keller.
Okay, making risk reports straight to the chief financial officer. What signal does that send? I mean, both outside and inside the firm.
It's a massive signal. It screams capital preservation is priority number one now. The CFO owns the balance sheet, right?
Right.
So putting risk under the CFO elevates it. It's not just some advisory group anymore. It's central to every dollar that moves. It changes where the power lies internally, big time.
And they didn't stop there. They also went after the trading side.
Yeah, they consolidated all the proprietary trading that's the firm trading its own money under one person, Mitch Petrick, the new global head of sales and trading.
Why do that? Transparency.
Yeah. Transparency and discipline, exactly. Before, you might have had different prop desks doing their own thing, maybe taking on correlated risks no one saw building up, putting it all under one roof, under one leader. That's about control, making sure another small team doesn't go off the rails, basically. It's structural damage control, plain and simple.
It's quite the contrast,
Yeah.
though. All this internal scrambling, this pain, and then they pivot so hard in the letter to talk about success.
Yeah.
The letter insists the write-downs should not overshadow everything else.
Yeah.
Which brings us to section 2, the core business strength.
Yeah.
And the magic word here seems to be diversification.
That's their whole argument. Look, the engine was still running strong in most places. Despite those massive mortgage losses, they still pulled in $28 billion in net revenue for 2007,
Right.
which was their second best year ever, revenue-wise. And investment banking, equity sales and trading, asset management, they all had record years.
All of them.
All of them. It really, really shows why having different lines of business matters, especially when one area just, blows up.
Okay, let's put some numbers on those successes. Investment banking, a record $5.5 billion in revenue. That's up 31% from 2006.
Huge numbers. And while their mortgage guys were getting hammered, the M&A advisors were absolutely killing it. Number one globally in completed deals for most of '07.
Incredible. And the trading floor, aside from that fixed income black eye.
Equity sales and trading. Best year ever. Revenues up 38%. Even within fixed income, the parts that weren't mortgage related, like interest rates and currency trading, they hit records too. Commodities had their second best year.
So the profits from those core areas were actually helping to plug the hole from the mortgage disaster.
Exactly, buffering the blow,
Yeah.
mitigating the damage. It shows the resilience of that diversified structure.
Now, you mentioned James Gorman earlier, the new co-president. The letter really shines a spotlight on global wealth management, which he was running. What was so special there?
Oh, the turnaround was just massive. They made $1.2 billion in profit before tax in '07. That's up 127% from the year before.
127%.
Okay, but here's the really telling part. The profit margin. In the fourth quarter, it hit 21%. Now think back to early 2006. That margin was only 2%.
Wow, from 2% to 21% in less than 2 years. What does that actually mean for the business?
It means they took wealth management from being, well, almost a drag on profits, maybe a necessary service but not a big earner, and turned it into a profit machine.
Right.
And wealth management is good business. It's sticky, clients tend to stay, it uses less capital than trading. Getting to a 21% margin shows they got clients into better, more profitable products and platforms. It completely validates pushing towards that steadier, client-focused income. Oh, and they also pulled in $40 billion in net new assets that year.
Okay, so they're fighting fires on one side, setting records on multiple others, and pulling off this huge turnaround in wealth management. Now, Section 3 suggests they weren't just playing defense, they were actively building for the future, even then.
That's right. They weren't just trying to survive. They were making strategic moves. They mentioned spinning off Discover Card earlier in '07, the MSCI IPO things designed to unlock value for shareholders.
Right.
But the really, really critical move, given the timing, getting that big chunk of cash.
The investment from the China Investment Corporation, the CIC, December 2007, just as credit markets were really seizing up.
Absolutely vital. Think about it. Getting billions from a major sovereign wealth fund right then, it was a huge vote of confidence. The letter plays it cool, saying it grew out of long-standing ties in China.
Sure.
But it was essential capital when capital was getting scarce. And it underlined their pivot-shifting focus towards these faster-growing, non-Western economies.
You can really see that pivot in the global numbers. International revenues hit nearly $16 billion, up 44% from 2006.
They saw where the storm was hitting hardest Western credit markets, and they sailed towards calmer, or at least deeper, waters. China revenues more than tripled in 1 year. They were rushing to get licenses, build up their presence there. It wasn't just growth. It felt like a strategic retreat to where the money still was.
And it wasn't just China, right? The Middle East, too.
Same playbook. Joint venture in Saudi Arabia, new license in Qatar, building a research team in Dubai. Their revenues in the Middle East were up something like 90% since 2005.
Wow.
They were planting flags wherever there was liquidity. India, same story. They ended an old joint venture to take full control, expand their own wholesale business, got a merchant banking license late in '07. It was a very deliberate global shift.
So finally, Section 4, looking ahead. What did they say they were going to do in 2008 and beyond, knowing things were about to get really rough for everyone?
They were pretty upfront, actually, acknowledged the near-term outlook is challenging, no kidding. But the strategy wasn't about shrinking, it was about doubling down on the parts that were strong.
So more investment.
Continued investment, yeah. Especially in those international and emerging markets. And within the institutional business, they called out specific areas. Commodities, equity derivatives, prime brokerage.
Why those areas specifically?
Think about it. Prime brokerage servicing hedge funds, that's a relatively stable, client-driven business. Commodities, equity derivatives, they provide hedging tools, things clients need, especially in volatile times. They're complex, high margin, and less about just betting the firm's own capital.
Makes sense. Shifting resources.
Exactly. Away from the pure balance sheet risk that blew up in mortgages towards these more complex client-focused areas. Same idea in asset management, building up private equity, alternatives, and in wealth management, pushing the private banking side internationally.
So it's all about stability, diversification, global reach, client focus, pulling back from that risky prop trading exposure.
That's the picture they paint. And the letter ends reaffirming that core belief. Max says they're still very positive about their business mix, that diversification is their great strength.
And that really sums up the key takeaway from this document for you, the listener, this 2008 Morgan Stanley letter. It's like a blueprint for how a massive, diversified financial firm tries to navigate an existential storm.
Yeah.
You see catastrophic failure in one corner, but at the same time, record-breaking success in others, fueled by that diversification. It allowed them to make that aggressive pivot, strategically moving away from the collapsing areas. The structure itself became the survival mechanism.
It really did. And it brings us back to that first response to the mortgage mess. changing the reporting lines, putting risk directly under the CFO, bringing in new leaders. So here's something for you to think about. When a huge firm is staring into the abyss, how much does that immediate management reshuffle? Changing who reports to whom actually matter compared to just, say, selling off bad assets or raising capital. Is changing the org chart the real fundamental shift?
A really interesting question to leave you with. Thanks for diving deep with us today.